Thank you guys for joining us today. We're super excited to be here with this Women and Wealth workshop. I think most of you know Capita is pretty passionate about education, and us being females in a predominantly male industry, I would say we're all pretty passionate about women in the industry as well, and creating these safe environments for people to be able to learn more and ask questions that you may have. I know there's a different language to finance, and sometimes it's intimidating if you don't know the language. So we wanted to create these opportunities for people to come together, support other women, and be able to learn more in a non-intimidating environment. So super excited for today. I'm going to give an overview of today's session. We're going to talk through some pretty exciting topics. One, why does it matter that women know about wealth? What are some unique opportunities for women in this space? Understanding the investment landscape of how to invest, what options are available, how to make smart investment decisions, and some long-term planning. So retirement, and other long-term goals and plans that you may have. So it's a panel discussion today, which we're super excited about. So we have three fantastic women in the industry on our panel today. I'm going to give a quick introduction of them. So Melanie Tinling, she is a relationship manager here at Capita. So she works closely with advisors. She's in lots of client meetings, so she gets the one-on-one experience of how people feel and think about money in women in particular. She has, her own unique experiences as well. Something fun about Melanie, she is a mama of teenagers, so you can imagine how busy she is. And she also ran track at BYU, which is kind of fun. So we love Melanie. We also have Alison Frasca joining us. Alison is a wealth advisor here at Capita. She's from San Diego originally, and Alison is one of the most organized people that I know. Yesterday, she was telling me about her meal planning, and she's just as organized there as she is with her personal budget. So Alison's awesome, super detailed. We also have Katie joining us, Katie Brinkerhoff. She's also an advisor here at Capita. Katie's amazing. She has two adorable little boys. And Katie actually has a master's degree in financial planning and analytics. And both Katie and Alison are certified financial planners. So super awesome. We have a really good panel today with lots of experience and understanding of the industry. So we're going to dive in. We have a couple of trivia questions to start out with. Before we do that, I'm going to explain the Q&A, how that works. So there is a Q&A function on here. You have the chat and the Q&A. The Q&A we ask you to use for questions that you have, then we can control if they've been answered or not to make sure we don't miss out on any. So if you have any questions, put it in the Q&A. We will have a full session, a Q&A session at the end, but feel free to ask questions as we go. We want people to be engaged. We want to make it very discussion so feel free to put your questions in as we go. So the first question is, what percentage of women feel confident in investing? And I know there's like 100 different answers here. So just type in whatever you may think that would be into the chat. So the answer, so statistics show that only 28% of women feel confident in investing. Now, what's interesting about this is compared to men are about 40% of men are confident. So yes, women are less confident than men when it comes to investing, but less than half of men and women feel confident when it comes to investing. And so I think that lack of confidence is a good place to start, because then you know to ask questions and seek help. And the best way, sometimes overconfidence can lead to worse investing, which is kind of interesting. So that's not a bad thing, but we want to empower women. Education is, truly empowering. So great job, you guys. We have one more trivia question. Who is typically a better investor, men or women? I love it. All these answers coming in, women.
Team women. Everyone's team women.
I mean, it is fair. We probably wouldn't put this in a True. A question about women in investing if the answer was men. Sorry,
Downer
Brinkerhoff.
than everyone here.
That would be a downer.
That would be a downer, yes.
Uh,
Um, So the answer is yes, women. A Fidelity study showed that women have outperformed men on average by about 0.4%. So it's not a huge difference. Some of the reasons are that women tend to sit tight more. So men, sometimes because of overconfidence, they'll make more trades more often, and that will lead to worse performance over time than women. So kind of fascinating. Great job voting yes for the women. So kind of fascinating to hear. Sometimes sitting tight is a good thing. Okay, let's dive into our panel discussion today, talking about the why and the opportunities for women in investing. So, Melanie, I'd love to hear your thoughts on it. Why should women participate in investment decisions?
Yes, so it's interesting. Women, they've done some studies and they found that women play a dominant role in household financial decision making. And I know most of you on here are not surprised by that. But according to a recent report titled Building Wealth: Insights on Women's Aspirations and Growing Financial Power, of married respondents, 60% said that they are the main financial decision makers in their household. And so along with that, not only are women, making some of these major financial decisions, we also may have different priorities than men. And another study indicated that men rank their number one priority, their top financial priority, as growing their retirement savings, while women's top ranked financial priority is supporting family. And that may include family planning, childcare, taking care of parents or siblings, and so on. And then one final other study by Goldman Sachs found that female investors are going to prioritize long-term planning, budgeting, philanthropy, and financial education for their children. So because we may have different interests and motivations and priorities than male investors, it's important for us to be educated in this sphere and decide where we want to have our money be and growing, and what causes we want those funds to be going to. Another reason for women to be involved in investing is that women face unique financial challenges. In the United States, women live an average of 6 years longer than men. And this means that they will need to save for longer retirement periods, and they may have higher healthcare costs as a result of living longer. Caregiving, we mentioned that just a minute ago. Historically, women tend to have more career breaks than men for caregiving for children and or adult parents. And then there's also the income gap. We still, in general, women still make 17% or so. That's what the most recent population survey found. The census found that women are making approximately 17% less than men. And so, that's definitely a financial challenge that we face. But interestingly, women are moving into positions of greater financial influence, and that is through generational wealth transfer. So a study done by Bank of America shows that an estimated $30 trillion in wealth will be shifting to women by the year 2045. And so we're going to be responsible for a lot of money. And so how can we learn how to make the best use of that?
That's a lot of money.
Yeah.
$30 billion.
Yeah.
A big deal. And I love everything that you said. And as we meet with women, so often we'll ask what's the financial need or the household budget, how much are people spending on a monthly basis? And I would say more often than not, the women know the answer to that question more than the men. So it is a big key, and women focus on the value of money more, the purpose behind it, which is so crucial to the plan. So I love that. Anything else that you wanted to add, Melanie?
No, yeah,
Thank you for sharing. That's great. Katie, I love this question. Are there certain investment opportunities that align with women's unique skills and experiences and life experiences?
Yes. This was like my whole personality for like a period of months in my master's program. I did like basically my whole thesis in my master's program was about women investors. And so it's kind of funny because women on average, right? Well, not on average, women are super busy and we're less confident about investing in the markets, but it's actually a good thing. So when it comes to making decisions about investments, it doesn't sound very promising, like, well, we're too busy, we don't have time to take care of it. We're not that confident, I don't know what I'm doing. However, it provides a really unique opportunity to outperform in the markets, like we've kind of alluded to before. Because, and even if it's on accident, even if it's on accident because we don't have the time and the means to go look at our finances all the time and essentially look at the markets and watch our investments, it's a good thing because long-term investing is more of a sit tight thing. Markets go up, markets go down. We don't think that you should sell when markets adjust like that, like they have been over the last couple of months. And so, if we're trying to simplify our investments, the simpler that we make investing, then the better off we'll be. And so although maybe we feel like I don't have time for that, I don't even know what I'm doing, it's actually a good thing. Just we'll talk through all of this later, but it's actually great. And we're here to be your cheerleaders, where it's like, awesome, we are going to lean into these unique circumstances that women are put in terms of caregiving and looking after all people and working and all these things that we try to do as women. And kind of think about it like a crock pot meal. Like, you put your dinner in the morning because you don't have time, you're not home all day. And then you come home and you get to enjoy your warm meal. It's the same with investing. You can put it in the markets, let it sit tight, and then you're going to enjoy your retirement, maybe more so than if you had pulled the lid off 6 or 7 times during the day and let all that heat out. And then I know we've mentioned some studies, but Wells Fargo just did a study in January, and they said that on a risk adjusted basis, meaning that women essentially take on less risk and do better overall. So they get kind of nervous. They don't do the more risky investments that maybe men would tend to do, but they're actually better off because of that. And so because of that, we don't have time to say, oh, markets have dropped, what should I do? Should I panic? We're just like, well, we were busy watching our kids or whatever we were doing. So it ends up being a really good thing. And studies have shown that again and again. So yes, women, we have a lot of unique skills and abilities that can make us really good investors.
I love that. I love the crock pot analogy.
Yeah.
That's great.
And just to kind of add on to that and tying back to Melanie's question as well, I feel like a unique skill that I've noticed in my day-to-day working with women is oftentimes women are better at keeping their long-term goals in mind while they're making financial decisions. Whereas sometimes I find myself more often having to remind male clients not to get hung up on specific things like tax details or specific holdings in different investments and things like that. And remember the big picture of what the overall goal is and what the long-term purpose is of the investments in the accounts, excuse me. I've just noticed that as like kind of a unique skill. Not necessarily everyone, but it is a pattern that I've noticed in my time as an advisor.
Thanks, Al.
Yeah.
We're going to pivot just for a minute and talk about understanding the investment landscape. So where do we start? What options are out there? I know we've heard a lot of things about index funds and a mutual fund or the S&P 500. I mean, what are we talking about? What are the different vehicles that we can invest in, and what are different strategies for that? So talking through the basics, Alison, this question's actually for you. What are the different types of investments?
Yeah, great question. So there's a lot of different investments out there. The most common ones that you're going to see are stocks and bonds. So Laura, if you want to flip to the next slide, the drawing a comparison between stocks and bonds. So a stock is an ownership in a particular company. So you're buying a share of ownership in that company. In comparison to bonds, they're a more aggressive investment, or you could say higher risk investment. But the trade-off there is that you're going to get higher return over a long time horizon for stocks compared to bonds. For bonds, those are going to be a loan that you give to a company or a government body, and then they pay interest on that loan, is essentially the gist of a stock and a bond. With a bond, they're going to be more stable, but that means the trade-off is they're going to have lower return over time. So when we're looking at those two main categories of investments, We're not necessarily saying choose one or the other, depending on what aligns better with your risk tolerance. Most portfolios, you're going to want a mix of both. And it really helps to meet with an advisor and determine how much stocks versus bonds should I have based on my risk tolerance, but also my life stage and all these other things that are unique to your situation. And then there's different ways to invest in stocks and bonds. So some common ways, you can purchase them directly. That's a common way. That's going to be the lowest cost option. But the risk there is that you're not well diversified enough, meaning that maybe you own 3 or 4 different stocks, but then you're too concentrated in those individual positions. So a great option outside of that is going to be owning a fund. The 2 main kinds of funds are going to be exchange traded funds, or ETFs. You might have heard them called that as well, or mutual funds. They tend to be pretty similar from a performance standpoint, but they function a little bit differently on the back end. So an exchange traded fund is passively managed, meaning that it's tracking one specific area of the market. So it might track the S&P 500 index, it might track value stocks or something along those lines. It's targeting one specific index or category of the market. A mutual fund, on the other hand, is actively managed. So it has fund managers that are looking to beat a specific goal or outperform a specific index, or maybe they're trying to target a specific goal, something along those lines. But what we've seen in the data is that the performance tends to be pretty much the same, or similar, I guess I would say. But with mutual funds, you're paying for that active management. So the cost of owning that fund is actually going to be more expensive. So that's why at Capita, our portfolios are always going to be either ETFs or a mix of ETFs and individual investments, because we've just seen the performance be relatively the same with mutual funds, but you're paying more for that investment. So that's kind of just the basics when it comes to investing in different ways to purchase stocks and bonds.
I love that. So you can purchase directly, choose a couple companies, buy directly into those. Or if you want to diversify, you don't have enough money to go buy individual shares of 500 different companies, but you want your $100 to be diversified across 500 different companies. Maybe you buy an index fund and you automatically have exposure to 500 different companies to help lower your risk. And you can either do that through an ETF or a mutual fund. Like Alison mentioned, those mutual funds will a lot of times have some higher costs built in because there's more active research and management going into it, whereas the exchange traded fund is more of just a passive investment. We're going to buy these specific companies and we're just going to buy and hold. Was that fair? A fair summary to say?
Yeah, perfect.
Awesome. Super helpful. And if you guys have any questions, again, feel free to put it in the Q&A. We'll keep an eye on it as we go. So there are different types of strategies when it comes to investing. We kind of talked here about the different vehicles in investing. You can buy stocks. Ownership is going to be more volatile. Bonds are going to be more stable. How you choose, do I want a stock or a bond? Probably a lot of that depends on your time horizon for the money. You know, do I have a lot of time to let this sit and ride, or am I going to need this in a couple of years and I don't want it to come down, you know, 10, 15%. I'd rather have it in a bond that's going to be more stable. So the time horizon of the money makes a big difference too. So what are the different strategies? Katie, give us an idea of the difference between strategic and tactical investing.
Okay, yeah. So Al talked about all the different ways that you can invest in individual investments essentially. But then now is the question is, okay, how do I build my portfolio? Which means basically your stocks and bonds. What should I put inside of what we call our portfolios, which are just your money that's invested? So tactical is also could be called active management or active management. So you're basically looking for outperformance by either handpicking stocks or making changes when market conditions change. And so you're, like it says, it's active, right? You have to be pretty actively involved in your portfolio. For example, something that's happened recently is we probably all heard about the tariffs that are happening or may be happening or have been changing in the economic environment. And so if you were a tactical investor, you would say, okay, well, I think that tariffs will mean that US companies will go up in value. So I'm going to therefore sell international stocks, buy US stocks. So that would be some tactical investing. Or you're saying, okay, I'm actually going to hand pick stocks. You're going to do research, research the financial statements of Target, and then decide you're going to buy Target as an individual investment. So you're hand picking, it's active. You're basically picking a specific strategy or stock investment. If you're strategic, or also known as passive investing, then it's basically set it and forget it. So you can do this a couple different ways. You could just say, okay, this is my strategy. I'm going to be 100% stocks. And of those 100% stocks, I'm going to put a third to large companies, a third to small companies, and a third to international companies. And then every so often, every year or 6 months or whatever you choose, you're going to basically snap the line back and say, okay, well, my large companies have grown, so I'm going to sell those and buy the companies that have not grown as much. And so you're rebalancing every so often, but it is realistically supposed to be more of a set it and forget it. You can do it the first way, like I mentioned, or you can just buy, like Al mentioned, or Laura mentioned, some index funds, which is if you've heard of indexes, they basically say, okay, for the biggest one you may have heard of is the S&P 500. So there's a company that says, okay, we're going to determine the 500 largest companies inside of the United States, and they just stick that in a list basically, and then certain companies like those ETFs, like she mentioned, just buy all those stocks. So they're not handpicking. They're saying, okay, someone else made this list of these biggest companies. We're going to buy those, and then they are the ones managing it. But it's a passive strategy because you're not saying, okay, buy Apple, buy Tesla. They're just buying whatever in that index is what it's called. And so here at Capita, we actually use both for our clients, like you mentioned. So if you want to move to the next screen, I'll show kind of the difference in between active versus passive versus the kind of the middle line for investment strategies. So this chart, it's kind of complicated, but basically there's 3 different lines you can see. There are 3 different strategies that are employed based on investing $10,000. So say that you took $10,000 and you invested it in 1980. So there's 3 different things that would have happened here. So say that you were what we call opportunistic or tactical, and you decided every time that the market dropped 8% in 1 month, then you would add an additional $2,000. So that's great. We want to buy when stocks are low. And so if you would have done that and taken advantage of low markets, buying when markets were low, you would have ended up with $2.127 million in about a 42 year time period there. So say you're the middle one, say you just want to be passive, you put in $10,000, you hold steady, you don't do anything, but you just let it grow. You're still way better off than if you would have put it in the mattress, right? You have $1.3 million at the end of that 44-ish year period. And then kind of the worst case scenario is say that you panicked. So say that you put $10,000 in, and then every time markets dropped 8% in 1 month, you pulled money out of the market. So you sold when stocks went down. If that happened, you would have had $615,000. So still better off because you invested, but because you kind of panicked when things went down, then you were way worse off than if you took advantage of the opportunities of markets going down. And so kind of the idea behind that is I think that both of the top 2 lines are great. I think that sometimes some people want to be active and tactical and pick individual stocks and buy more when things go down. And that's great. And that can provide some good opportunities. But even if you're just going to be an active investor, you're still way better off than if you hadn't had nothing in the markets.
Yeah, if you're passive. So passive, so just to summarize, tell me if this is right. So that green line is passive, just buy and hold, don't make any moves during the market ups and downs. Blue is if we're investing more when things are scary. Easier said than done. Sometimes you look at it and you're like, oh, great, I want to be the blue line. But what that means is when the headlines are scary, everything's going down, you're putting more money into the market. So it's a lot easier said than done. But that gray strategy would be panicking. When things are coming down, I want to get out of what's bleeding. Small companies are hit hard, get me out. And so then that shows, it's quite a bit of money as far as the difference goes after that 43-year time period, if you are going to be tactical, but on the scared side of it. So tactical can be good or bad, but you have to be pretty disciplined. So that's why a lot of times we're reminding our clients, stick tight, let's stick to the plan. If we want, we can invest more as things are scary and try to go for the blue. But if we're not, then let's at least stay with the green. Let's hold and sit tight and let things recover rather than panic and potentially lower our returns.
Love it. Thank you.
Thanks, Katie. This was awesome. Okay, so how do we make smart investment decisions? Melanie, what are some of the things that women should consider when making investment choices.
Okay, absolutely. And I'm backing it up a little bit here. So I'm a fairly new investor. I had a life change. I went through a divorce midlife, and so I am starting, a little bit more towards the beginning than many people at my age. And so I had to learn a lot about different investments and things like that. But backing up even before that, something that I feel pretty strongly about is having an emergency fund. We talk about investing and we talk about wanting to grow money and these types of things, but when we're just plugging along and all of a sudden we have unexpected home repairs or auto repairs, maybe we have a huge dental bill or childcare costs or a job loss, that all these things are things that happen in life. And if we don't have emergency funds to pay for those, a lot of times those costs end up on a credit card or some other high interest type thing. So I would say, first off, before even embarking on an investment journey, make sure that you've got what you need as far as a long-term savings emergency plan, 3 to 6 months or so. And different experts have different opinions on how long that should be, but ultimately it's what you feel comfortable with and what you can do. And then next, if you have high interest debt, it may not make a lot of sense to be putting a bunch of money into investments, where you're making some interest, but you're paying a whole bunch of interest to a high rate credit card or something. So make a plan for paying that down and off, and then moving more of those funds into investing.
Can I intercede
Yeah,
real
go
quick
ahead.
now? We did a study a couple years ago, and I think the average credit card rate was 16 to 17%.
Yeah,
That's average. I mean, I've seen some up to 30,
20s and yeah.
20s is super common, up to 35%. So if you're, paying that much interest on your credit card while your investments are maybe earning 9, 10, 11%, you're net negative. You're losing more
Yeah.
on the debt than you are, just paying it off. So I always say, that's a guaranteed return. You put $1 towards a 20% debt, you just guaranteed a 20% return on that dollar. So I think that's super crucial, paying off that high interest debt and then building the emergency fund so you don't have to get into more debt as life happens.
Yes, exactly. And in a weird sort of way, paying down that credit card debt is investing. It's not what you want to be putting your money towards, but it's the reality that, I've got this and I've got to take care of it. So let's invest this money into this thing. And then eventually I'm going to be investing it into something that's going to give me better returns than a credit card, which, so, yeah, thank you. The other thing, and Katie touched on this, is your risk tolerance. So with that graph, that was a great visual image. When we're talking about scary times in the market, are you the one that's wanting to, saying, hey, do I have cash? I want to put some more in. I want to buy. Or are you the one that's more like, I'm going to be good if I just write it out and try not to bite my nails, or are you the one stashing your money under the mattress or pulling it out completely? So that's what risk tolerance is. It's the emotional side of investing. How am I going to respond when the market is going up or down? What level what level of sanity can I maintain with my investments? And that's a really important piece of investing. So, yeah. Does anybody have a comment there?
Well, yeah, I was just going to say, I think it's better when I start working with someone, I always try to show this is what could happen to this type of portfolio based on the risk. Are you comfortable with that? If the accounts were to come down that far, would that make you panic and want to go to cash? Because if so, let's start off lower now so that we don't make that decision then. Overall, you're going to be better off by starting off your risk a little bit lower if it's going to help you not panic when things are bad. So I love that, understanding your actual risk tolerance. An advisor can help you understand your capacity, the financial ability to take on risk, but we want to match that to your tolerance so that you don't panic when things are bad.
Yeah, absolutely. I agree. And then another piece of it, and this has been mentioned, is also diversification of assets, which, it's don't put your eggs all in one basket. It's if let's say that you have a great company that you're working for and they give you a lot of stock, but that's all you have. That can be a little bit scary if something were to happen to your company. We want to make sure that we've got investments in lots of different areas so that when one area is going down, it's not taking our whole, life savings with it. And these, wonderful wealth advisors on here. They can talk more about that. And then finally, just avoid scams and fraud. If it seems too good to be true, it probably is. That old adage, it rings true here with finances. You want to invest in things that are trusted sources, reliable. One article I was reading talked about, going with trusted friends and family. However, that can be a little bit scary too, because there's a lot of things that friends and family get involved in and want us to invest money in that often don't end up being the best thing. So it's really, really important that you vet out the investments and the people that are handling your investments to make sure that it's a good situation for you.
Thanks, Melanie. The only other thing I would add is looking for a 401k match. So Melanie touched on a lot of the financial fires that we often talk about, high interest debt, not having an emergency fund, but another one is missing out on a 401k match. That's probably the closest thing to free money we have in our day and age. And what I mean by that, a lot of times if you put money in, they're going to fully match that. So it's a 100% return on your money. It's a really good investment. So always make sure you're putting enough in a 401k plan to get your full match. That's another big thing when you're making these investment decisions. And life insurance is also a big one too. Make sure you're covered with life insurance in case something, the unthinkable happens and someone passes. We want to make sure you're taken care of. So I love that. So those are the 4 that we often talk about: having a good emergency fund, getting the 401k match, paying off high interest debt, and then making sure you have good life insurance coverage. Beautiful. So, Alison, how do you align your investments with your financial goals? Let's say you have some things in mind. How do you make sure everything matches up?
Yeah, great question. I mean, initially, the first step here is just figuring out what your financial goals are. So you might have some things in mind. You might not really know what your goals should be. And that can be a really good conversation to have either with an advisor or even just with like friends and family, like what their goals might be and what opportunities are out there. But that's definitely step one, is determining what your financial goals are. And it can be something as simple as I want to purchase a home, or I want to retire at this age, or whatever it is. It doesn't need to be anything complicated or crazy. Just the overall goal working with an advisor is we want to know what you want to do with your money, and then we want to help you get there by doing all the math and the boring stuff on the back end. So that's really step one. And then Laura, if you can go to the next slide. So there's a couple of different layers when we're talking about aligning your investments with your overall financial goals. The first layer is going to be asset allocation. So all that really means is what percent of your overall investments is allocated to stocks or bonds or maybe cash, things like that. And so that asset allocation is going to be determined by a lot of different factors, but they're all based on your individual situation. So it's going to be your goals. Once you've determined what those are, your current life stage that you're in, again, what your risk tolerance might be, and then withdrawal needs. And there's a few other factors that we kind of bake in when we're putting together an investment recommendation on our end. But that's why it's so important to know what your goals are, because you're going to invest very differently if the purpose of that account is to buy a home in 5 years versus if it's for a retirement account. So that's really a great way to align your investments with your financial goals, is having an understanding of your current situation, and then determining how that aligns with the investment. So kind of a general principle there is the longer the time frame that you have to work with, the more aggressive you can be with investments. So tying back to the example that I just said, if you're looking to buy a home in the next 3 to 5 years, you're going to be a little bit more conservative in that kind of investment account. Whereas if we're looking at a retirement account that you're not going to use for 20, 30 years, maybe even 10 years, we can be more aggressive with the investments in that account because we have time to recover from any market downturns that might happen during that time period. And then there is a second layer to it as well that's more objective. So inside of that asset allocation, when we're looking at individual investments, so like a comparison would be if you're going to own Coke stock or Pepsi stock, that's really going to be objective. A lot of those more nitty-gritty decisions are going to be based on market research. So it really is less tailored to the individual person when it gets down to that level, and more on like what's the market doing, where do we see it going, how do we feel about the fundamentals of specific companies and things like that. But really the goal that we've touched on several times already is being well diversified. Melanie talked about you don't want to put too many eggs in one basket. The analogy I always use is you don't want to have a third of your portfolio in Tesla stock and then Elon says something dumb and you lose a ton of money, right? So that's really an idea of why you want to be well diversified, is you want to make sure that you're spreading out your risk across different categories in the market, and also taking advantage of different growth seasons in those different categories of the market. So that's really a great way to align the overall financial picture with what your goals are, but also make sure that it's tied into what the market's doing. And of course, working with an advisor, we can really help you hone down how does all of this tie in together? What does it mean that I have XYZ goals? How does that translate into a financial portfolio? So we're here to answer those questions and help you figure that out.
I love it. And it's so nice when markets are doing scary things, when we can talk to somebody and say, don't worry, your allocation, we have enough money in bonds to fund your withdrawal needs for the next couple of years. We have different buckets of money. And it's kind of what asset allocation is, right? With our long-term money, we're more aggressive. Our short-term money, we're more conservative. We're just fine to sit tight and ride this out for another few years. We've already set aside the money that you need in a safe bucket. So it also brings huge peace of mind, as markets are volatile, as we've seen, recently. So I love that, Al. Thank you.
Yeah.
Okay, Katie, what are some of the common mistakes to avoid? I actually love this question. The other day I heard something online about this certain type of nail you can get, and it can cause this bad allergy and make your nails fall off. So I'm like, oh, got to be aware of that. So I love hearing about the mistakes of others so that I don't have to make those. So what are the common mistakes to avoid?
Yes, I think it goes along with what we've talked about before, but essentially timing the market. We don't want to make decisions based on emotion. And so probably that's the number one, is let's make sure we're not making decision. Number two, I would say, is analysis paralysis. I think that people don't do things because they don't know where to start, and that's gonna be you're gonna be way worse off not starting than starting somewhere, even if it's the wrong type of investment for your age or whatever it is. So the scenario of markets dropping and then women going in and making ill-timed decisions, ill-timed adjustments, is far less common than men, because like I mentioned before, we're providing for our families, for our jobs, for our pets, for all those things. We have so much else going on that we don't have time to make those common mistakes. So that's kind of nice, where we feel like, we're less likely to make those mistakes because we have so much going on. But the analysis paralysis, shameless plug, Capita has so many resources that we can tap into. There's on our website, you can go on our website, there's an education center. We have YouTube, Instagram, we'll do a free meeting with you. We'll help out in any way we can. So don't let the unknown of what you don't know what you're doing stop you from just starting somewhere. You'll be way better off by starting now, whether you're close to retirement, whether you're still in your early ages, in your 20s, whatever it is, just start somewhere, and we would love to help with that.
Almost everyone I meet with feels less prepared or less knowledgeable than everybody else. Everybody feels that, and it is hard to be vulnerable, but I love what Katie said. Some sort of plan is better than nothing. So don't be afraid to ask for help and just start somewhere, and you will be better off. I love that. Okay.
Yeah, just to kind of add really
Alison.
quick, like there truly are no stupid questions. Like, reach out to Capita. We're here for any and all questions, because I am sure I speak for all of us when I say, like, we've all been in that position. Like, there was a certain time where we didn't know what a stock or a bond was. We're in this industry, so we have that knowledge now, but outside of this industry, it's hard to find that information or to find reliable information. So don't feel like you're the only person that feels that way. I would say most people feel that way.
Love that. Okay, this is our last section or topic here: retirement and long-term planning. Alison, this question is for you. How much should women save for retirement?
Yeah. So, at a high level, it's going to be mostly objective how much you should save for retirement. So in a lot of ways, it's going to be very similar to the recommendation that we would give to men, but there are a few things that women specifically should keep in mind when we're looking at this topic. And if you want to hop to the next slide. So really, when we're looking to save for retirement, a good kind of baseline goal that you can shoot for is to replace 70 to 80% of your working income. The general understanding is that it's going to give you the same exact lifestyle that you had while you were working. And the reason behind that is there's a lot of taxes that drop off when you retire, that you're no longer paying into because you're no longer working and paying into certain things. And also, you're no longer contributing towards retirement accounts. You're now benefiting from those accounts. So there's a lot of costs and taxes and things that go away. So that's a good goal to shoot for, is replacing 70 to 80% of your working income. So then the question is, how do we get there? So like Laura mentioned earlier, at a minimum, you want to make sure that you're contributing enough to get your employer match from your company, because again, that's 100% free money. If you don't know what that match looks like, reach out to your HR or your boss or whatever, and figure out what that employer match is and how much you need to contribute to get it. In addition to that, ideally, we're shooting for 10 to 15% of your income going towards retirement savings or just investment savings in general, or maxing out your 401k is a great target as well. One thing to keep in mind is we don't want to completely sacrifice your style of life right now just to make sure that you have a good retirement. So that's really something that we're balancing here as advisors and at Capita too, is we don't want you eating ramen now so that you can drive a Ferrari when you're 65, right? So it's really a balance, and it's a good conversation to determine what can you realistically fit into your current budget, and also working with an advisor to determine what am I actually on track for, like what level of income would my current plan provide me in retirement, and how does inflation work into that. So that's a great conversation to have with us. But some things that you really want to pay attention to, especially as women, is, again, statistically women live longer than men. So I've seen it happen a few times where someone's worked with an advisor before, maybe an investment firm, and the whole financial plan was designed around the husband. And it's like, well, we probably have, maybe 3 to 5 extra years to plan for here, both with investments, pensions, all those kinds of things. So you really want to make sure that you're part of that conversation and that the plan is tailored to every party that's involved in that plan. So those are some things to keep in mind. One other note that I like to touch on when I talk about saving for retirement is Social Security, because that's a big part of a lot of people's retirement. But keep in mind, Social Security, when it was originally built, was only designed to provide about 30 to 40% of your income in retirement. So if anything, it's just a good reminder that some of that responsibility falls on you as well. So you want to make sure that you are putting money towards your own financial future, over and above what you will get from Social Security, just to give yourself a good, happy lifestyle in those retirement years. But anything to add, you guys?
I think you covered it really well. That chart on the right, it's really fascinating, how much of your income you should be saving to replace your income in retirement. And if you're in your 20s and, 30s even, it's pretty easy to do. So that just shows the benefit of starting sooner. And if you're not in your 20s and 30s, totally fine. It's still better late than never to get a plan going. But I just love that reminder, action sooner than later pays off and makes a big difference.
Yeah, and it really depends on your individual situation too, because it depends on what kind of lifestyle you want in retirement. It depends on your current income, all those kinds of things. So there are factors to consider, but definitely the target of contributing enough to get your employer match or shooting for 10 to 15% of your income is going to be a good starting point.
Perfect. Thanks, Al. Katie, I know we've talked about this a little bit, of risk and risk tolerance, but how do you truly strike or find that balance between the risk versus the reward over time?
Yeah, I think that this is like a very generalized way of thinking about it, but if you have a runway or a time frame that's longer than 10 years, you really should be in close to an all stock portfolio. So if you have, the stats say that if you have 10 years ahead of you, that you have a 96.6% chance of your accounts being up at the end of that 10 years. And so if you want to go, I think there's a next slide that shows the odds of like winning big in Vegas versus the odds of investing in the market. You can see that, you know, there's a less than 50% chance that you'll go win money in Vegas if you're playing casino games. But the odds that you're going to be in a good situation in 10 years, you can see the last couple of bar charts. 10 years, you have, I guess the specific study said a 93% chance. And then in 15 and 20 years, 98% chance over a 15-year period, or a 100% chance over a 20-year period. You should be in all stocks or close to an all stock portfolio, because that gives you the best returns long term. And so once you get in that 10-year period where, you know, you're getting close to retirement, you need to add some other fixed income or other things in your portfolio, then, you know, you can add some other bonds and reduce the risk that way, have some stability inside of there. But in general, I think, and that was a big part of my thesis in when I did my master's degree, was because there's that gender pay gap, because we're making less on average. I actually ran the analysis, said, well, what if we made less, but we kept an all stock portfolio clear up until we retired, which is not realistic. We don't really want to do that. But in some cases, women were better off doing that. They were better off than men, even though they had made less overall. And so even though markets are going to do, in general, if you're in a diversified stock portfolio, you're in good shape, reach out. We can help with asset allocation, help you find the right stocks and bond mix for your specific situation. But you probably can be more aggressive than maybe you think you can be.
I love that. So we talked about women living longer, women making less money because of that gender pay gap. So Al, what are some strategies that can help women retire comfortably?
Yeah, for sure. There's a lot of things to keep in mind when it comes to retiring comfortably. I kind of want to take a step back from finance, because I feel like this more personal conversation is one I've had with a lot of clients lately, where some of them are nervous about finances, which is totally normal. Your income changes as far as like where it's coming from, and a lot of things change from like a financial standpoint, and even healthcare and things like that. But honestly, this is a conversation I've had with my own mom as well. Is you go from a lot of times working full time or dedicating a lot of your time and energy to things that take up all your time and energy, to retirement where you're really deciding your own schedule and trying to figure out what do you want to spend your time on. And there's pros and cons there. So honestly, some of the advice I've been giving to clients, which is hilarious because I'm far off from retirement, but it's just from feedback I've gotten from my retired clients, is coming up with a game plan of what do you want to fill your time with, so you feel like you have kind of a soft landing into that transition. And it's such a positive experience if you're planning ahead for it, because now you really get to dictate your time and what you want to spend your time and energy on. But if you don't have anything really that you're preparing for, or that you want to focus on in those retirement years, then sometimes that can feel really intimidating. So kind of outside of the financial realm, I feel like that's always just a good nugget to throw in there, just based on the feedback I've gotten from other clients. But touching on finances specifically, if you want to flip to the next slide. So referring back to wanting to replace 70 to 80% of your income to keep that same lifestyle, that means there's a few different things to focus on. So we already talked about, you know, it's best to start as early as you can. The earlier you start, the less you have to save in order to get to that overall goal, and save as much as you can, but within reason. Again, we don't want to overextend ourselves and drastically decrease our current lifestyle just for purposes of retirement. But you do really want to shoot for saving maybe 10 to 15% of your overall income, maybe even a little bit more if you can swing it, just to give yourself peace of mind for those retirement years, and even potentially retire a little bit earlier than you thought. And then we've touched on this a lot, but be aggressive with your investment. So oftentimes, especially like in your 20s, 30s, 40s, sometimes even 50s, it makes sense to be 100% stock, because like we said, you have time to recover from those market downturns. The statistics show that your portfolio is going to be up 95 to 100% of the time over that kind of time frame. But you also don't want to take on too much risk. So that's a great conversation again to have with an advisor or whatever that looks like, to determine what's an appropriate amount of risk to take on, and how aggressive should I be in my accounts. So again, working with an advisor, we can help you figure out what that trajectory looks like and what's a good fit for your situation. And then there's other things to keep in mind as well when it comes to retirement outside of just investments. I already touched on Social Security. So just making sure that you're planning for that and what that might look like. And also keeping in mind that it's not intended to provide all of your income in retirement. And also being mindful of healthcare. So thinking about, if you retire before 65 and you don't have access to healthcare through your spouse, then you're going to have to get on some kind of private plan in the interim before you reach that Medicare age. So there's other things outside of investments, like I said, that it's important to be mindful of, and just make sure that you make that transition as easy as possible.
Perfect. Thank you. And we're actually coming up here on our Q&A session. We just had an awesome question come through. It says, when the time comes, how do you actually sell stocks in your portfolio? Do you just list how much money you want and the brokerage will sell enough to get that amount? Everyone talks about how to invest money, but how do you literally fund your retirement? How do you get that money back out? This is such an awesome question, because a lot of times people have the putting money in, investing it down, they're good at that part. But then when you go to take the money out, it's kind of a different story. There are a few different things to be thinking about. One is, which account am I taking it from tax-wise? Am I taking it from a pre-tax account that's going to be taxable to me? Or do I need to be aware of, some income or marginal tax bracket? So maybe I want to drop from Roth. So that's the first decision. Which account is it coming from? The second decision is, which investment is it coming from? Am I going to sell some of my individual stocks, or am I going to sell from my stock fund, my index fund, or am I going to sell from my bond fund? And so you want to make sure that you have those different buckets of money set aside. And then you can go in, and if you're doing it yourself, yes, you can go in and say, sell this amount out, and then it'll cash out. And then you can send that direct deposit to your accounts. If you have an advisor, they'll do that for you. So you don't need to worry about all that. You just say, this is how much money I want. And then your advisor can help you determine which account it should come from, which investment it should come from. Especially if markets are down, you want to be really careful about that second question. So we don't want to sell your stocks when they're down, because then you've locked in those losses. So that's why we love the bucket strategy and only drawing from your safe buckets, especially when markets are down, and then making sure you get the right amount. And also thinking about, how much taxes am I going to withhold from this, so I don't just take out all this money and end up owing a bunch of money at the end of the year. So lots of things to think about when you're drawing from your portfolio. It's a little bit more complicated than when you are investing. So yes, if you're doing it specifically in a brokerage account, you could go in and say, this is how much I need, sell that. There are a few different ways to do it. But if you have an advisor working with you, they will do all of that for you and make sure you're being really strategic around it. Great question.
Yeah.
And we do have, I know we're coming close here on time, but we would love to answer any questions that you have. So feel free to drop them in the Q&A. We did have some final thoughts about supporting women. So Melanie, I'd love to hear your thoughts, as if any questions want to come through, we'll watch that. But how can women support each other in financial growth?
Yes. Well, we're doing it right now. We're talking about it and learning and getting education, and that's empowering. So anytime we, feel like we're not as savvy about something, if we want to just go out and find resources or reach out to others who are also interested in those same things, there's women's financial circles that you can join. You can find these in the community. Local organizations such as libraries or community centers often host financial get-togethers. There's online groups on, Facebook, meetup.com, LinkedIn. You could start your own if you had a group of women that, were feeling like you wanted to learn more about investing. Start it like a monthly book club, whatever format works for you or on your own schedule. And then finally, Capita, we host a few events. We've got one coming up, and Laura just put the slide up, this Brunch and Learn. This is going to be in July. and it'll be at our office here in Draper. And, you know, those of you who came to the last one know that it was just a great time, and lots of good learning and chatting and all the things that, and good food, all the things that we love as women. Good learning, talking, and food. So there you go. And then finally, we're also working on something really pretty exciting and special here at Capita. That's going to be a mentorship program for women who are looking to return to the workforce after taking a hiatus for whatever reason, if it's caregiving or, you know, whatever it was that took you out of the workforce. Sometimes that can be really daunting to get back into it. And so we're going to be, stay tuned for more on that, but it's called Return and Rise, and it's going to be really, really amazing.
Beautiful. And we did have another question. How much do financial advisors cost? I love this question. In our industry, sometimes it's hard to know because so many different advisors, different firms hide a lot of the fees. So it can be hard to know what you're actually paying. You need to be aware of expense ratios and then the advisor fee. Here at Capita, we wrap it all into one. But basically, so it's different for every advisor that you work with. Here at Capita, we just charge a flat annual percentage on any assets that we're managing for you. And we always like to be open and upfront about our fees. So if you want to, you know, call and talk to us, there is no cost for that. And then we would tell you, okay, based on, you know, this asset size and the investments we're choosing, this would be your total cost that you would pay for all of our services. So always feel free to reach out. We can run a quote for you. You can scan that. And the brunch and learn is completely free, no cost. So if you want to join, we can go back to that. Let us know, just send us an email. We'll send out an invite as well. We'd love to have you join. There's no cost to that. So please join. Thank you guys so much for joining us today. We'll hang on for a few more minutes. If you have other questions, you're welcome to add them into the chat. But we really appreciate you joining today. We love women empowering women. And we do think that knowledge is so powerful. So always feel free to reach out with any questions you may have. All of us here are more than happy to answer those questions, and we hope you can join us in July. Thank you so much.